begin with, normally what happens is we all know that new tax regime is by default our tax regime. So in case if you want to opt for an old tax regime, then in that case, you have to opt for it. So if initially I have opted for new tax regime and later on I realize at the end of the year that my old tax regime was better than new tax regime, but my TDS has been deducted as per new tax regime. So in that case, you don't have to worry about it. You simply file your return as per the old tax regime. You will get the tax benefit. But one thing that you need to take care here is if you have income other than PGBP, then only you can switch over from old to new or new to old tax regime. But if in case we have PGBP income, then in that case, this switchover is not possible. Similarly, some of the employees, they invest in FNOs. So FNO income is PGBP income. So in that case, you will not be able to get the benefit of switching over from old to new or vice versa. Similarly, in case of HRA, we all are aware of the benefit of HRA. The only concern here is that you can pay HRA to your close relative also. That is, you can pay HRA to your spouse, you can pay it to your parents, you can pay it to your brother and sister. The only concern that arises here is that it should be properly documented. That is, you should have a rent agreement. You should share the PAN number to your employer. Then you also should have rent receipts. Simultaneously, if the rent amount exceeds more than rupees 50,000, then TDS at the rate of 5% need to be deducted once in a year. Similarly, the next point that need to be taken care is NPS. So we all are aware of that. Under section 80C, maximum deduction that is available is of rupees 1,50,000. But NPS gives you additional benefit of rupees 50,000. So section 80CCD1 is available only to old tax regime, not to new, but 80CCD2 is available to under both tax regime, that is old as well as new. Similarly, under section 80CCD1B, there is additional benefit that I have already discussed of rupees 50,000 to the employee contribution. Next point that need to be taken care is capital gains. So whenever employee incurs a capital gains, there's a huge tax liability on that. So we need to take care that your advanced tax liability will start from the quarter in which the capital gains have actually arisen. One thing. Similarly, in order to have the tax saving on capital gains, you need to invest in certain investments. So you should be aware of all those investments, the capping on those investments, and the time limit within which you have to invest. So all these things need to be taken care to save your taxes on capital gains. And last but not least, so what we do is we do tax planning. So tax planning is at the beginning of the year, it is not at the end of the year. So at the end of the year, it is a just hush hush affair, and you tend to invest in anywhere where you have a tax saving, but you do not get the maximum return that you would have got. So you must see the overall that your overall purpose should be resolved while investment. It should also do tax saving. Along with that, it should also give you maximum returns. And last but not least, you should not keep all the eggs in one basket.